Thank you for taking time out of your schedule to join us here, and we appreciate your work.
Thank you very much. Thanks, everybody. Thanks, Jim.
Fed Chair Jerome Powell there concluding his remarks at the SABU conference in Arlington, Virginia. Much anticipated remarks, including by President Donald Trump, who had truthed just a few moments before Powell took the stage that he should actually cut interest rates. Ending there on some Grateful Dead references, a little eerie when you see bleeding across this entire market. I do want to just reference some of the headlines that Powell gave. He said that while tariffs are highly likely to generate at least a temporary rise in inflation, it's also possible that the effects could be more persistent. A slight change in tone from his last press conference, where he insisted that any tariff impact would be temporary or transitory was the word he actually used. He did say this, though, too: we are well positioned to wait for greater clarity before considering any adjustments to our policy stance. It was a very sanguine, calm Fed chair. He did say that calm was one of the things that he was supposed to provide, and he said that we'll have more clarity in a year. I'm not sure that this is a market that can wait a year for more clarity and for more of a response monetary policy-wise. Let's take a look at what this market is actually doing right now. We saw Treasury yields drop about 10 basis points across the board. A little bit of an improvement since Powell spoke. You see 362 there on the 2-year, 364 on the 5, 393 on the 10-year, and then all the way out to the 30-year. You're seeing that same drop again, even that far out, in spite of the fact that the Fed chair said that longer-term inflation expectations do seem to be still anchored, and that those are the ones that he is more concerned about. Let's take a look at the broader market, because we have the Nasdaq flirting in and out of bear market territory. Right now, you see the S&P 500 at 5178, down more than 4%. The Nasdaq 100 down more than 4%, just off the lows. The Russell 2000 down 4.6%. And that VIX reached 45 earlier on. A little improvement there too, but I'm not sure if you'd call 39 an improvement. Let's take a look at commodities, because we have an incredible drop for WTI. Oil, which certainly will provide some deflationary tendencies around the world. Crude oil in New York trading at 61.83. That is down just in this session alone 7.6%. We have gold as well coming off the boil, down about 3%. Very, very few areas of this market are higher. DXY up about 0.5%, but that's from an incredible low. So let's get to some analysis now of what Fed Chair Jay Powell said. Just a few moments ago, he spoke to how strong the impact of President Trump's tariffs are shaping up to be.
While uncertainty remains elevated, it is now becoming clear that tariff increases will be significantly larger than expected. And the same is likely to be true of the economic effects, which will include higher inflation and slower growth. The size and duration of these effects remains uncertain.
I'm joined now by Michael McKee, global economics correspondent and policy correspondent. Michael, I want his coach, because he does not seem to be concerned whatsoever, and yet this is a market that is flashing SOS signals.
It's partly requirement for Fed chairman, I think, to be calm in all of these situations. But basically, Jay Powell's message was there is going to be damage to the economy from the president's tariffs. I'm not going to comment on the advisability of the tariffs, but he just sent a message to the market saying there is no Fed put. They're going to watch what the actual impact on the markets is, or on the economy is, rather than the markets. So don't expect them to come to the rescue anytime soon, basically telling the president, no, I'm not going to cut rates right now. And probably they are more likely to raise rates, in that he said we are going to see inflation and unemployment rise. And what we end up doing is looking at which one is farther from where it should be, and then we take monetary policy action to bring that one back in line. Inflation is likely to go up faster than unemployment, and so at this point, it looks like the Fed would be holding rates where they are. That would be their preference. If they go up, if it goes up really fast, they might be raising rates before they would consider any kind of cut, Vonnie.
And indeed, he did say, in response to one of the questions, that the whole committee is thinking ahead to May 6th and 7th, the next monetary policy meeting. They have a month. There'll be a lot of data in that month that won't necessarily reflect the tariffs, though. So when he says it feels like we don't need to be in a hurry, is he right? Should they not be getting ahead of this?
They probably don't need to be in a hurry, in the sense that right now, well, from their point of view, in the sense that they feel that their policy is still somewhat restrictive. It's leaning against inflation right now. Inflation is likely to go up and may go up higher than people think, but it's not going to shoot up in the way it did, say, maybe in 2022, so they can wait and see what that inflationary impact is. And there'll be debate about that on Wall Street, whether they did the right thing, whether the timing is correct, and they may change their minds by May 7th. But at this point, that's the way they see it. You notice the graph we had up there a second ago. The markets are sort of seeing this. They had priced in as many as 5 rate cuts before the end of this year. Now they're down to 4. We'll see if that continues to get pulled back as other Fed officials speak and as the data come in.
Yeah, it's a market that seems to reprice constantly at the moment. Michael McKee, thank you so much. That is Michael McKee, Global Economics and Policy Correspondent. Let's check Treasury action once again, because we all know what's going on in the stock market right now. We don't need to do that. We do see the 10-year yield at 3.94, so we're down about 8 basis points as money flows into fixed income. The 2-year yield standing right now at 3.62. We're more than 100 basis points from where we are just a few months ago. We have the 10-year break-evens at 2.18, the 30-year yield at 4.36, down 11 basis points. So certainly this movement is across the curve. It is not just at the front end of the curve. What is the reaction right now? What are your clients saying? What's the first question that you get asked?
Well, first, certainly the question is how are credit markets holding up? And so far, till February, they had been resilient. They've been looking through the volatility in the equity and the rates market. But that changed in early March when there was clear signs that the soft data was turning. And that's one of the reasons why we increased our spread forecast for the high yield market in mid-March. This is even before we had any inclination about tariffs. Now the risks are clearly skewed to the upside. While we could argue that some of the soft data could be considered noise and argued away, there are certain other indicators in the credit market, particularly pertaining to the credit market, that have real and measurable impact on our asset class. For example, indicators of CapEx activity are turning south, so is M&A activity. And these are, again, these have real consequences for the C-suite. And so as we stand back and look at credit, high yield is about 400 basis points. We've had 60 basis points of widening yesterday, which is the single biggest day of widening since COVID. We are not pricing in a downturn yet, but risks are certainly skewed to the upside.
Viktor, let me ask you, how concerned did you become in the last 2 days? And what about this market price action?
So I think the thing that has changed over the last few days is that this is increasingly becoming a little bit less just about who's exposed to tariffs and more about broader cyclicality, meaning, how bad is this impact on global growth and what are the recession probabilities? And here, most people, and we, would probably go back to the first Trump period, 2018, and see what were the market impact back then. I think this time you're dealing with a situation which is similar but worse. Back in 2018, the tariffs weren't as broad-based or as high as they are today. Back in 2018, inflation was much lower, and to Chair Powell's point, the inflation expectations were much better anchored. So you're probably talking about a bit of a worse situation than in 2018, and that means that when you look at spreads in credit right now, they probably need to price in more recession risk today than they did back then. We would think, if the recession probabilities in credit today are somewhere around 30%, they probably need to be 40, 50% or so to sort of accurately reflect the risks right now.
Yeah, that means we have more repricing to go, right? And is that going to happen? I mean, are we coming in Monday looking at a very difficult day once again?
Well, the risk has clearly skewed to the upside because, again, the only certainty is uncertainty at this point. But at the same time, as Chair Powell said, this is not 1970s. So yes, there is risk of stagflation, but we have to be measured in how we approach this because there are certain silver linings in the credit market as well. So for example, the credit quality within high yield is the single best it's been in a decade. We have more double Bs now than we have had last 10 years. Fundamentals look good. Leverage is at 4 times. Coverage is at 70th percentile. So there are certain indications that the storm could be weathered unless there is a recession on the table. Outside of a recession, these are great levels in terms of yields, 7-8% in yields. Some of these numbers investors have not seen in more than 5 years. And on the other side, supply is limited as well, which should keep technicals well balanced.
But at the same time, is it an opportunity or is it something to be absolutely avoided until we know more? The Fed chair said we'll have more clarity in a year. That's a long way away. Neil Dutta this morning saying the Fed is reactive, not proactive, and can't offset a trade war. We all know that, right? It can maybe do something about inflation or perhaps unemployment, but it can't offset an entire trade war. And he also says that Trump is playing Russian roulette, not chess. This is just going to get worse. So would you catch a falling knife here? Would you put yourself in that position?
Well, yeah. So for us, we came into the year liking decompression and dispersion. We knew that credit risk is going to be higher this year, even before tariffs were announced. And we continue to believe that that we have to be careful in putting more money to work. So the trade here would be up in quality, up in liquidity, up in capital structure. This is what we came in with, and now we believe in more so post-tariffs.
Amaury, can you answer that as well?
Yeah, no, absolutely. I mean, on our side, I would say we have been overall pretty cautious, and we have a favor quality, I would say, over on the credit markets. I would say there are, however, some opportunities that maybe we should look at. In the current market context, I would say that Europe should hold better than the US. When we look at our studies over, let's say, a commercial war, usually the country that is imposing tariffs is the one suffering the most. That's what our studies show. On the other side, we see as well that when we look at Europe, there is this, let's say, fiscal package from Germany that everything being equal should weight and push GDP higher. And so finally, and in line with just what Powell said, when we look at US versus Europe, ECB is in a better position to act on rates than the Fed. Both may have an issue of growth because of what's happening with tariffs, but Fed has a bigger issue on inflation than the ECB, which means that everything being equal, ECB will be able to act better and to push lower rates right now than the Fed. So it is more supportive for the European credit market than the US credit market. And what we have seen in the recent, let's say, last few days, that both markets have reacted the same way, which is quite normal in such kind of turmoil. But in terms of relative value and opportunity, I think it makes sense to go for the European markets, even whether we look at the credit spreads or whether we look at duration.
All right, I want to go to something that Howard Marks of Oaktree said a little bit earlier on. He was speaking in the context of what he literally said was being like a snow globe shaken up in the last few days. That's what the market is experiencing. But let's have a listen to his view on the whole trade war and how it's shaken up these markets.
This is the biggest change in the environment that I've seen probably in my career. We've gone from free trade or world trade and globalization to this system which implies significant restrictions on trade in every direction and a step toward isolation for the United States. The world economy and the world order beyond economy, meaning geopolitics and international relationships, has been shook up like a snow globe by the events of the last days, and nobody knows what it's going to look like.
Before we get to some analysis of that and the dire circumstances that Howard Marks feels like we might be in, I do want to give you one piece of good news, and that is that the SpaceX private crew has actually splashed down after a polar space flight. You can see the pictures there, safely splashing down that SpaceX private crew, so that is one good. Piece of advice and piece of information. But we have a third IPO now on delay. Ryan Reynolds' Mountain is also delaying its IPO. Earlier we heard that Klarna is delaying its IPO and also StubHub. So this market a little bit grinding to a halt. Victor, can I go to you on what Howard Marks just said, plus all of these extraneous facts about IPOs not happening and so on? Given that Howard Marks has been around for everything, all of the currency crises, the 0809 crisis, the temper tantrum, COVID, and he says now we're in the biggest change of environment of his entire career. Is that what it feels like to you?
I've been through a few of those as well, I have to admit. But look, I think one thing that is quite important about credit actually here is that some of this uncertainty is actually positive, right? You know, the inaction, the delay of decisions, you know, the sense of needing to be conservative, you know, that's not good stuff for the economy. But it can be good for credit quality. You will have companies that decide that against all this uncertainty, we may actually need to be a little bit less leverage than we were before. We may need to target a little bit of a stronger credit rating profile than before. We may issue fewer bonds than we were planning to do before. All of those are mitigating factors when it comes to credit risk. So companies obviously will have the need to respond to the uncertainty in a way that might suit credit quality over time. So I think there is at least some silver lining coming from the uncertainty.
Neha Khoda, I'm coming back to you in studio here at Bank of America. Obviously, there will be some opportunities. Do we wait till next week? I mean, do we jump in right now? And where would you be looking for those opportunities?
Look, I think I would echo something that Victor said. There will always be need for credit. And even right now, as it seems that headwinds are stacked up against us, there are some tailwinds, and they are meaningful tailwinds. So the credit composition, the quality composition of credit is good and remains supported when it comes to the demand side of the equation. And so we think that there will be a floor of prices and a ceiling to spreads when it comes to, say, double Bs and certainly the IG part of the market. There are some troubled credits, which, you know, there will be some such sticky situations, but those are limited to mostly the 5 and 10% of the overall credit market, mostly on the loan side, not so much on the high yield side. But again, I think here we go up in quality, we choose fixed over floating and ride the duration and high quality credits.
Amaury Dorsey of Amundi, I want to get back to you and ask you, the Fed chair did say that, you know, recession risks are rising and that, you know, across the street we're seeing those odds go up, but that they were from a very low level. How much do you see the possibility of a recession in 2025? And do you think 4 cuts are about right this year?
Well, for now, our base scenario is that we do not see it's not our best case scenario to see a recession coming. We think that it's too early to really look at the recession. There are many uncertainties, and so we are in line in a way with what Powell said. And by the way, I would say that given what he said, which is it's too early to talk about, to know about really what's happened to the growth, but he said as well that things will be inflationary. And from our point of view, the market as of now is really strongly focused on growth, which makes sense, but not enough on the risks of inflation. So you discussed and you said that break-even in the US is at 218 right now. At this level, we do believe that it's the right level to start to buy those break-evens, either through chips or either through inflation swaps. We do believe that the market is ignoring too much the long-term, let's say, inflationary pressure that could weigh on the market.
All right, I have to thank you all. Unfortunately, we don't have enough time to continue this conversation, but you've all been amazing. You can stay there for 2 seconds, Neha. Neha Khoda of Bank of America. We have Viktor Hjort joining us, Global Head of Credit Strategy at BNP Paribas, and also Amaury Dorsey, Head of Fixed Income at Amundi. And let me go through those markets once again. The 10-year yield right now, 392.33. We saw a 10 basis point drop. The 2-year yield, 358.83, and the 30-year yield, 435. 339. So the 10-year break-even, as I mentioned earlier, 218. The 2-year break-even at 326. And of course, we are seeing the bleeding continue in stocks as well. We have the Nasdaq 100 down almost 5% now. We are officially in bear market territory for the Nasdaq 100. The Russell 2000 taking it on the chin once again today, down 5.2%. And that VIX is above 40. Do continue to stay with us. Continued market coverage at this crucial time here on Bloomberg.